Welcome to BTA, Breakout Trading Answered, the show where we talk about all things breakout trading. And today we're going to be talking about account size, which is incredibly important. Why? And how do we make sure that we got the right account size? Well, we're going to be talking about that today with Mr. Breakouts himself. Welcome, Thomas. Welcome to the show.
Thank you very much. Mr. Breakout is back, but almost didn't make it. As you can see, I'm in a communist t-shirt today, red one, because yesterday I was supposed to fly to Vietnam, which is a communist country, and they didn't send us the visa, so they didn't let us on the plane. So today I'm officially celebrating the day of red flag and Viva la Vietnam. No, I'm joking. We'll make it today. We'll make it today. Yeah. That happens when we're traveling. That happens.
So you're in an unexpected hotel, a different environment, but it's good to see that you're here, and we're going to do the show anyway. So well done.
Yes, this is highly improvised. Okay, so welcome back, guys. Great to see you all. And actually, you know what, Andrew? I have my Starbucks coffee. Look.
Oh, you have your Starbucks. Okay.
Yeah, I got it in 7-Eleven.
Excellent. It's everywhere, isn't it?
Well, that's good.
Yeah.
Fortunately, yes. We're going to talk about the account size for the futures trading. I think it's a really neat topic because people think that they need a lot of money to trade futures. And I'm going to show you guys that's not exactly the case. Although I think we have to emphasize that futures are for serious traders. It's not like micro lots on Forex where you basically don't risk much. It's just, it's not for playing. It's not like you open $100 account and you're just playing and trying what you can do. Futures always have been for serious traders due to their advantage of low correlations. They have absolutely incredible advantage that no other markets in the world can offer us. But this advantage comes with a little bit of a cost. The cost is that really futures are for traders who can afford it. And by afford it, I don't mean you need tens of thousands. We'll show you today that even with a few $1,000s, you can start quite comfortably and give yourself good chances. But yes, futures are not for people who just want to improvise a little bit with $200. That's not the case. And I think that's good. I think that's good that we have a vehicle which is really serious for serious trading and serious business only.
Yeah. So before we get into the slides you prepared today, can you also comment on why it's important to make sure that you've got the right account size and the dangers of being undercapitalized? Yeah.
That's a great question. So the account size comes mostly. There are a couple of aspects. So first aspect is that your maximum drawdown never will be the size of your backtest maximum drawdown, meaning that in live trading, you need to expect higher drawdowns than in the backtest. That's always the case, always. I've never seen a strategy that would perfectly copy only the backtest historical drawdown. The life is always worse. And it also comes to the question, what is your mental resilience? Because some traders, they say, oh, I don't mind drawdown. And usually traders who are proclaiming that they do not mind drawdown of any signs are the first one who are freaking out when they get into 5 or 10% drawdown. In 20% drawdown, they already broke down. So we need to understand that, there will be drawdowns and the account size has to somehow respect the resilience we have. And also, we don't have to, we want to avoid the risk of ruin. We want to avoid margin call. So there are a lot of aspects. But rule of thumb, you need to get ready for drawdowns and you need to set your account in a way that you can really go through these drawdowns without getting too emotional and switching off your trading or destroying your trading business.
Yeah, very well said. Nothing to add to that. So how about I pull up the slides and we can get started in the main content of today.
So guys, how much do you really need to trade futures? Brilliant $1 million question. And maybe just $1,000 question. Who knows? We'll show you at the end of this show. Stay with us because I will I will start with examples, which will make you freak out. It will be like, oh, I need a lot of money. Not the case. Stay through the whole episode. You'll see that that's not the case. Actually, you can start with a very reasonable account. So we will talk about 4 different aspects that have a big impact on the size of the account you need. And these aspects are, first, your maximum strategy drawdown. Second, whether you are day trader or swing trader. Third, whether you trade full, E-mini, or micros, futures contracts. And fourth, that's the biggest one, is portfolio. Especially the fourth one, I think you'll see some real magic. And again, this is the advantage of futures that we have and that we can leverage to start trading with a reasonable size of the account. So let's talk about the maximum strategy drawdown. This is a pretty big one. As I said, right, you can be 100% sure that your live trading maximum drawdown will be worse than what we saw in the backtest. So let's start a little bit from an extreme, but at least we will start with something familiar for the audience. So if you remember, guys, and Andrew, a couple of weeks ago, I think it was before Christmas, we had this episode called Beat the S&P Index, where I showed real time how to construct a very simple yet powerful strategy in pretty much 5 minutes, just using one strong tendency. This, by the way, this episode got a lot of views. It's quite popular. So if you haven't watched it yet, go back and watch it. And this was just an example that it's not difficult to beat S&P index with one simple idea. However, we need to say that this strategy had a pretty big drawdown, and I commented on all these aspects in the show itself. So if you remember, Andrew, the drawdown was, I think, about $20,000. I think we have it here on the next slide. Yeah, about $20,000. Now, that was the 10 years backtest. And I admit this is a high drawdown, and I comment on all this. And we still can get back to that previous slide. I'll explain one thing. So that was a big one, 20K. I explained everything in that show. This is an extreme. But you need to understand that really this is the backtest, and the reality will be, and I would say it's pretty much, if you want to be on the safe side, would be good to count at least 1.5 time of your maximum backtest drawdown. There are various techniques. Some of them can include Monte Carlo analysis as well. But if you want to start with something really simple, 1.5 of the previous drawdown, that's the safe part. Now we can move just to prove this idea, right? The idea that your future drawdown will be bigger than the backtest drawdown. It's very easy to prove. If we would take this same strategy 3 years earlier, because the original one backtest went until the end 2022. Now let's say we would take the data, the backtest only until November 2018, so 3 years earlier, and now we would say, oh, 15K. Okay, so I need 15K I need 15K capital to trade this strategy. But is this the case? Well, it is not, because if we move to the next slide, we can see exactly what I just said, that following next 3 years, we would get close to that 20. So if you take this rule of 1.5, 3 years ago, you would take that 15K, multiply it by 1.5, and you would arrive to $23,000, which would get you ready for upcoming drawdown in live trading, which would be definitely bigger. Here it was 20K. So that's why this is the basic rule, 1.5. But this rule already keep you safe, will keep you safe, and it's a very easy rule to follow. And again, we're talking about extreme drawdowns here. Don't worry, it will get much better, but it perfectly demonstrates the need of 1.5 at least of the maximum drawdown strategy, historical drawdown strategy.
Yeah, that makes sense, Thomas. We've got a question in the chat, but I might save it for a little bit later.
Okay.
Yep.
Okay, cool. So this is the first one, historical drawdown, and you need to really honor that. and continue with that 1.5. And we will work more number, and I'll show you how progressively get better and better. And at the end, you'll see that you need just a couple of $1,000. So let's move to the next one. So we covered the maximum drawdown. The next one is whether you do day trading or swing trading. In general, swing trading produces higher drawdowns. That's the way it is, because we hold our positions overnight. We can also risk the overnight gap. So there's definitely high risk and high drawdown. This is the same strategy from the same episode, the 5-minute strategy. The only difference is that I swapped the swing trading exit, which was originally on Friday, for end of day exit. So I turned swing strategy into day trading strategy. Now you can see that you pretty much slashed, I don't know, maybe 80%, 70, 80% of that original drawdown. So if you're short on money, you might need to start with day trading strategies where your drawdown will be way lower. And believe me, it will be also way lower than 12K, which you see here. Again, we're starting with some major extremes. So in the original example, you would need a lot of money for the swing strategy. In this example, again, we take 12K, which is the maximum intraday version drawdown, or drawdown the intraday version of the strategy, multiplied by 1.5, and we will arrive to, I think it's on the next slide. That would make it 18,300. So it's at the top. So again, for the day trading, we're already getting to lower numbers. So that's a big one, and that can help you a lot if you're struggling with the capital. Again, this is an extreme. We will go to better numbers. If we move to the next slide, and now I think it's starting to get interesting. Now you have absolutely amazing. So first of all, as I said, drawdowns 12, 15, 20K, like the drawdown 20K that I showed you on indices, it's really, really high. This is an example of a strategy from my hedge fund index strategy. Here the drawdown is 7,400. So now we're getting to a different, actually, sorry, this is silver. This is silver, and on the silver strategy, the drawdown is 7,400. So you definitely can get strategies with way more reasonable drawdown. You can get day trading strategies. You can get day trading strategies with about 5,000 US dollars drawdown. So 20, 25K, it's really, really an extreme. Now, the beauty of this one is that you can, with futures, you can now trade micros, and micros are 1/10 of the original size. So what I can really do, I can take micro silver, and micro silver is 1/10. So the drawdown would be $740, which again, I need to multiply by 1.5. And all of a sudden I'm getting to $1,100. So now we got from 30K probably just to start with one strategy to just $1,100, and we can start trading futures. And this is amazing. I think the micros, it's one of the best contribution from the from the commodity exchange CME to traders, regular retail traders, because now we just need a couple of grand and we can start trading futures. So that's another one. Like you move to micros, all of a sudden things get way better. Any question regarding this one?
No, not yet. All clear.
And now, guys, comes the real advantage of futures. And this is the biggest one. This is the reason why we professional traders trade futures, no stocks. I love stocks, don't get me wrong. I used to do a lot of option trading on stocks, but stocks have very high mutual correlations. The only category of markets where you can get mutual low correlation across different markets, it's futures, period. There's nothing else out there. And now you can leverage this incredible way. So now you could say, okay, so how about if I want to trade 3 strategies, how much money do I need? Well, you don't need actually 3 times of one strategy, because if you deploy low correlated markets, then you can get up to 60% of the drawdown reduction, which means if you assemble a portfolio of low correlated markets and strategies, you can get a lot of bangs for the buck, you say, Andrew. You know,
Yeah.
I'm specialist in
Bang,
proverbs.
bang for
Bangs.
your buck. Yeah, that's good.
Did I say? Oh,
You
that is
got
the
it
first
right.
time the first time ever when I got an English proverb or saying right. This is the best bangs for the buck. So I'll show you, and this is the whole idea of futures. This is why you guys want to be with futures. This is serious business where you can make a lot of opportunities with very reasonable amount of money. So now we finally put it all together. So let's get back to silver strategy. So let's say that we have a one silver strategy. Day trading drawdown is $8K, $8,000 on a normal silver contract. Very, very normal. This is not an exception. That's very normal. Swing trading 12K, again, quite normal. Now, if you apply the rule of 1.5, then you would need basically 12K to day trade, or 1,200 for micro, and you would need 18,000 for swing trading of the regular contract, full contract, or 1,800 for the micro. A lot of money. So it almost looks like unreal to trade a portfolio of 3 strategies. It almost looks like, okay, I want 3 swing strategies. Doesn't mean I need 3 times $18,000, which would be $54,000. Well, the great news is you don't, because now we take the edge of we take the advantage of the edge of low correlated markets. So if we go to the next slide, now what we can really see is that if we deploy another 2 markets which are low correlated to silver, for example, let's say soybeans and EMD. EMD is E-mini S&P 400. So E-mini S&P 100, soybeans and silver have pretty low correlation. They don't have so much in common. And so that means that we can take these 3 strategies, and the portfolio reduction of these 3, the drawdown will be up to 60%. So basically, we can now calculate that normally we would say, okay, day trading, let's say each strategy has got $8,000. Maybe we will need 3 times 8,000 plus multiplied by 1.5. So that would give us $36,000 for day trading. For swing trading, it would be even higher, $54,000. Now, what we can, and this is, if you construct your portfolio well, you will very quickly and easily get a portfolio reduction of the portfolio drawdown by up to 60%. If you do your job well, if you do your homework well, easily you reduce by up to 60% these theoretical numbers, and you will realize that actually to trade 3 markets, you will not need 36K for day trading, but only about 14,500, and you will not need 54K to swing trade these 3 markets, but you will need about 20 and approximately 20K, which you can now trade with micros. So you can basically launch a small portfolio with about $1,500 for day trading and $2,000 for swing trading. I mean, this is great. Like, we can start trading 3 different markets, 3 different strategies, futures, 2K account. Hallelujah. I think this is magical. And that's just because of the fact that we can use this portfolio reduction. Now, in reality, you will use a little bit higher, because of course, we didn't get into this mental resilience. So let's say if you're willing to accept, let's say, 30% drawdown, you need to multiply this. This would be like 1/3. So for day trading, you would probably need about 5K, and for swing trading, you would need probably 6, 7, 8K. But you can comfortably start trading futures with micros with a couple of $1,000. And as I said, this is a serious market for a serious business. This is not like, goofing with micro lots on Forex. This is a different vehicle, different animal. It's like really, really serious business. And you can basically start a small portfolio of normal or E-mini futures with, I would say, $20,000-$30,000, which is more money already, but then also you can make more money.
Okay. You've got another slide. Do you remember that? 5 strategies.
Yes.
Okay.
So I was waiting. If there are some questions.
There's questions. I was going to save them for after the next slide. Yeah.
Okay. So now let's push it a little bit further, and now let's talk about 5 strategies. So with 5 strategies, actually, again, same logic. For day trading, normally we would think 60K, for swing trading 90K, which is major. Again, if we take the advantage of low correlation across futures markets, the reduction will be up to 60%. So we can trade 5 strategies, day trade 5 strategies with about 30K account, and we can swing trade 5 strategies with about 40, 50K account. And for micros, it would be 1/10, which again, I think that's incredible. Like, just put in a couple of grand and you can start trading micro futures with 5 strategies portfolio. So that's really so much better than it used to be. And if you can afford a bigger account like 50K and you already have 5 strategies, that's great, because you can already make some serious money. I remember we launched our very first portfolio in the hedge fund, the first CTA program. It was 1K program, $100,000. Sorry, no 1K, 100K, $100,000. And we had, I think, 5 or 6 strategies. I think we had 5 because we wanted to allow very low drawdown, which was something like 15 or 20% maximum. And the first year we made like 80%. So that's great with 5 strategies. And if you make it a micro, low drawdown, good return, with basically $10,000, still great.
Yeah. Now, I just want to say as well, I'm not sure we have micro contracts for all of these markets.
We don't actually. That's a good point.
I know you don't keep up with it, and I don't trade micros either. So I don't think we've got all these. But the concept, still applies. So So a question. So on this portfolio 60% reduction, would you ever adjust that based on the level of correlation in the portfolio, or did you just think that's like a blanket number you would use no matter what?
I think this 60%, it's really when you get close to the ideal correlation. So we're talking the correlation between these strategies on at least monthly, but ideally weekly basis, should be somewhere, the average between all markets should be somewhere between 10 to 20%. If you get this level of correlation, then the portfolio reduction 60%, it's very reasonable. If the strategies on average have a correlation higher, like 50, 60%, the reduction will be significantly lower, can be just 30, 20, 30, 40%. But the point here is that we have the great advantage and luxury of working with low correlated market. And that's our extra edge, that it's almost our obligation to deploy this in a way that we achieve a low correlation, 10, 20% on that small portfolio. And it's super doable. I think it's maybe, I would almost say, easier than it sounds. It's not doable on other markets like stocks or Forex, very difficult. It's so doable on futures. So doable.
Yep. Okay, we've got a couple of questions in the chat here, Thomas. I'll start with this one from Ikanch. Would you use the same calculation for increasing the position size as the account size increases?
We're getting into more complicated the topic of position sizing here. I suggest we spare position sizing to the next episode, because then can get really complex. I probably would not use the same logic. because there are more elements in position sizing. And by default, you could, like, it's not a mistake, right? It's better to have at least some logic than none, and this logic could be applied. So yes, you're right. What was that? Yeah, you could use it, but I wouldn't use it. I would go beyond that. But that's also a good tip for some upcoming episode. So we'll explore that later.
Yep. Thanks for the question. There's a question here from MyFX. Let me put this up on the screen. It's 2 parts, so I'll just put the first part and then I'll just read the second part. So, given you know your capital requirements, how would you calculate the money you need to deposit if you want to lease your strategies or portfolio with Striker? For example, let's say your portfolio requires 100K capital. How much would you deposit with a broker? Not specific to Striker. It does apply to any broker. So, how do you figure out? It's a good question because brokers go bust sometimes, right? So do you want to have your full account size with the broker, or how do you figure out how much you can keep there safely?
What is the worry here? Like, what is the? So if for example, you want to lease a portfolio from a developer and he recommends 100K, why would you want to deposit any other amount of money but 100K?
I think the question is more he wants to lease his strategies and portfolio through Striker.
Oh, his strategies. Okay. He has to offer his. Okay,
that's how I read it.
Not leasing. Okay. Right. Okay. And he needs to figure out what would be the capital that he would suggest for clients. Like, what would be the minimum for clients? Probably.
I don't know. Maybe MyFX. Can you specify in the chat what exactly? What you mean? The way I understood it is, if you know your portfolio has 100K size based on what we've just been through here, how much of that money would you actually set with the broker? Would you put the whole thing in, or would you say, okay, I need this for margin and this for a little bit of drawdown, or how would you figure it out?
I would put the whole thing in. If I calculate that I need 100K, I would put in 100K. Definitely not less.
Right. Okay.
But I might maybe I'm not understanding the question correctly.
Right. Okay. We'll see if MyFX can give us a bit more clarification in the chat. So that was MyFX question, Ikan's question. I think we can continue with the next slide, Thomas, and we'll come back when MyFX can clarify a bit more. So,
sorry, MyFX. Maybe I just need more Starbucks. That's it.
Yeah.
My brain is still kicking in. Yeah.
Yes. Okay. So, what is the next slide, Thomas? I can't see. Here we go.
Yeah. so I covered everything about the futures trading, but my whole message was that it's really doable because people think, oh, futures, that's not for me. I need a lot of money, blah blah blah. No, it is for every serious trader, everyone who wants to build a serious business. I can afford at least a few $100, and I think people who usually want to create a serious business, they do have this kind of capital. They can afford it. Like everyone, futures are for everyone. It's some big misconception in the industry that it's complicated. It is not. It's not for everyone. It is for everyone. I think the benefits of correlations are just incredible. This was just my suggestion. If you guys still are thinking about futures, I just want to emphasize that in my book, The Breakout Trading Revolution, not only I share there a proven breakout trading formula that you can apply very successfully on futures trading, but I also share a lot of case studies and samples of strategies on futures market. I list a lot of strategies from our hedge fund, from our clients, other successful traders. So if you still don't know if you want to start with futures, if you still have your hesitations about future trading, do not be afraid. Just just go with it. Go through this book, which will show you a lot of possibilities that you can achieve with futures trading combined with proven breakout formula, and just do it, because I think whoever is not seriously considering futures trading, really depriving him or herself from a great opportunity to use this extra edge of low correlation, which is major. So again, if you want more case studies or combine it with a formula, read this book. I think you will be amazed what is all possible.
Yep. Okay, we've got a question here from Woohoo Beef Stew. Good to see you, Beef. Here we go. Put it up on the screen. What type of money management would you apply to a small portfolio for quick growth?
I understand. So if you want to grow quickly, you need to allow yourself a high amount of a drawdown. So usually your performance, the relation between your return and drawdown will be a ratio somewhere between 2 and 3 to 1. So let's say you have a good portfolio, good strategies, so you're able to make 3 times of your maximum drawdown. So if you are willing to accept 20% drawdown, you're giving yourself chances to make 60% return. I do have some clients from the past and even friends who are very aggressive. They're very resilient when it comes to drawdown, and then very normally they risk 50% of their account, and this way they can make about 150% return per year, even more. I saw that, but their drawdowns were really, really big. So if you want to grow really quickly, you need to, that's the first requirement, you need to accept bigger drawdown and be fine with it. But also you must not I would say, you have to be very honest with you. If you cannot survive 50% drawdown, if you will start, like being really challenged at the level of 20 or 25%, then there's no way to grow it quickly. Because sooner or later, with quick return, there will be quick drawdown. That's the way it is.
Yeah. I think actually in Van Tharp's position sizing book, he talks about some techniques to grow accounts pretty quick, doesn't he? We was that the last episode we talked about books for advanced traders, I think, or was it the one before? Yeah. Maybe it was one before. So, yeah,
that's a good one as well. Yeah, the definite guide to position sizing from Van Tharp. It's a brilliant book. And if you're already in a stage when you have experiences, you know your drawdown tolerance, you can speed up the growth of your account with these techniques. But it really is for more experienced traders a little bit, because thank you. Yeah, at least you need to know your drawdown tolerance, and not theoretically, practically. Like theoretically, everybody thinks that he's a master of Zen and he can survive 50%. Everyone. In practice, very few, maybe 5% of people.
Yeah.
My experience with,
Okay, sorry. Go on.
Yeah, my experience with traders is that mostly they can survive between 15 to 25%.
Yep. Yeah, I think we've all been through that experience, right? The first big drawdown, we're like, oh man, I was way off.
Exactly.
All right. Thanks for answering that question. Thanks for the question, Beef. It looks like that's all the questions in the chat. So before we finish up, if we could, if you enjoyed what Thomas shared on the show today, then please give us a thumbs up for this video. And also hit the like and subscribe buttons so you're notified when we release new content. And Thomas, do you have any final closing words, parting shots before we wrap up today?
I will be a little bit redundant here, but again, my message is do not be afraid of futures. Futures are awesome, not complicated. They might look like at the very beginning, and the benefits of futures are just absolutely amazing. Once you start understanding what all you can do with futures, you will fall in love with futures and you will never want to go back. We do have clients who abandon Forex or stocks and stay with futures now because the benefits are way bigger. And all you need for the beginning is just a couple of $1,000. Worth the try. What is there to risk? Very little.
Yep, exactly. I'm one of those people who abandoned stocks for futures as well. I don't think I'll ever go back to any other market. Futures is the best by a long way. So, all right. Well, thank you, thanks for sharing that, Thomas, today and the slides. Thanks for creating those, and thank you for everyone for turning up today and some good questions in the chat. And hopefully you enjoyed it, and we'll catch you again next time. Ciao.
Thank you very much. Happy trading.
Happy trading.